Welcome to Robit's second quarter and half year analyst and press conference. My name is Arto Halonen, I'm the group CEO and I'm here with Ville Peltonen, interim CFO. We had an excellent second quarter and I'm very proud of the Robit team who delivered these results. We made record both in net sales as well as in EBITDA. Our net sales totaled 31 million euros and was supported both top hammer and down the hole segment. Both of the businesses grew by 23.7%. Orders were flat, resulted to 26.4 million euros. We are seeing the impact from Russia order decline faster in orders than in net sales. Also, we were pleased to see that all of the market areas delivered growth in the second quarter. This was enabled by also completing the investment plans we have had for especially our top hammer business. We successfully executed the profitability improvement measures, and that shows in the strong EBITDA. EBITDA resulted in 4.1 million euros and 13.1% as a percentage of net sales. The improvement actions were focused on pricing management, procurement savings, as well as addressing some of the lower profitable customers. In all of these action points, we made good progress during the quarter. Strong profitability resulted also into positive net cash flow from operations. One of highlights from beginning of the year is also that we took good steps towards our sustainability targets, and as an example, the CO2 emission intensity took a great step towards the right direction and towards our targets. We are very pleased with the strong quarter two. First half of the year, we also saw good growth. Net sales grew by 19.2%. In fixed currencies, 15.5%. Growth was mainly driven by the top hammer business, which grew to 27.7%, but thanks to the strong second quarter, we saw also growth in the down the hole business growing with 8.8%. EBITDA went back to growth curve thanks to the strong EBITDA and profitability development during the second quarter of the year. We've seen also strong improvement on the cash flow from operations, which improved 5.1 million euro and was positive 1 million euro during the first half of the year. We are still seeing some challenges in the freight market, and the transportation lead times are still longer than normally, which is negatively impacting on the net working capital. Although there has been some improvement on the freight market, it's not yet visible on the let's say lead times as such. Also, the cash flow from before changes in net working capital improved to 5.6 million euros. As mentioned, we grew in all market areas. Growth was strongest in Americas during the first half of the year, where net sales grew by more than 60%. Also, we had a good growth in East, where we delivered the existing backlog we had for the Russia order. We entered the year with a very strong backlog for our Russia business, and now we are finalizing the deliveries of that backlog during quarter three. And gradually we will see let's say Russia-Belarus business to let's say decline from the levels it has been. On the sustainability front, we took good steps in many areas, and as a highlight, the CO2 emission intensity that I mentioned already. There we have, for example, increased the share of renewable energy at our Perth factory, and that was one key contributor that we achieved 21.3% reduction in our CO2 emission intensity as compared to the baseline year 2020. And our target is to halve our emission intensity by 2030. I will hand over to Ville. Ville will cover the financials in a bit more details.
Okay, thank you, Arto. Like Arto said, we had an excellent second quarter. Our key financials reached new records in Q2. Net sales, strong growth, 23.7% higher than the second quarter in 2021, which was also a record-breaking quarter for Robit. In fixed currencies, we grew by 17.4%, so we got a little help on the top line from the currencies. EBITDA continued to develop positively and improved by 2.2 million euros from the second quarter of 2021, and we reached the 13% level that has been our key financial target. So we reached that level in the second quarter. EBIT for the second quarter was also positive, reaching 8.4%, improving from the 1.8% in the second quarter of 2021. Also, our result for the period was positive 2.1 million euros in the second quarter and 1.3 in the first half of the year. Now let's look at the net working capital development. NWC totaled at 51.1 million euros, slightly decreasing from the level we were at the end of the first quarter, and the trend is starting to decline. Inventories increased to 47.4 million euros, and the increase was impacted by the cost inflation we've seen in the past months, as well as the FX rates. Receivables increased to 25.7 million euros as a direct result from the strong growth in sales and invoicing. Net working capital will be and has been in the short-term focus of Robit, and we have several actions ongoing to lower our inventory levels. We have reduced the amount of SKUs, and we have optimized the product offering of our business segments. Cash flow developed positively as a result of the strong profitability. Cash flow before changes in net working capital improved to 4.8 million euros and 5.6 in the first half of the year. Operating cash flow was 1.4 million in the second quarter and 1 million in the first half. Cash flow from investing activities was minus 0.4 million euros, mainly related to the Top Hammer investments we have made, and cash outflow from financing activities resulted in minus 1.6 million euros, which includes the 1.5 million loan amortization we had at the end of June. Here you can see the trend of cash flow before changes in working capital. We are back on a positive trend as a result of the strong second quarter. Our financial position remains steady, cash and cash equivalents at 7.1 million euros, and total interest-bearing loans and utilized credit limits were 38.8 million, including 7 million from the lease liabilities of IFRS 16. This year, in the first half of the year, we have lowered the level by 2.7 million euros. Capital structure. So our net debt was 31.7 million euros, slightly down from the beginning of the year, and our net debt to 12 months rolling EBITDA ratio was 3.47. The equity ratio remained solid at 45.7%. So loans from financial institutions at the end of the second quarter totaled at 29.1 million euros, and we still have 3.5 million from the loan agreement made in 2021 remain to be raised at later stages for possible investments or else. Loan amortization schedule is 1.5 million euros biannually, so at the end of June and then at the end of December. In May, we also agreed to extend our financial agreement to a new 3-year period, and we still have one extension option left for next year. We also have an interest rate swap of 10 million euros, which will take effect at the end of June next year for a 3-year period ending at the end of June 2026. Back to you, Arto.
Thank you, Ville. We continue our focus on profitable growth. So our target has been to get profitability on a growth curve, and we took great steps on that front during the second quarter. Pricing management, procurement savings, addressing low profitable customers have been the, let's say, key action areas in this profitability improvement focus. In a short term, we focus heavily on net working capital. As Ville mentioned, especially there's actions on inventory level to plan better our inventories, to control our inventory levels better, at the same time secure good availability to our customers. We have also actions ongoing, let's say, on the other elements of the net working capital, receivables, payables side that we are looking into to improve the cash contribution. We have also focused sales actions to compensate for the Russia-Belarus sales that will now gradually decline as we are not taking new export orders to these markets. We are only delivering our existing backlog, and backlog we will deliver during the quarter 3, and then quarter 4 we have only maybe some minimal sales from our local inventory that is already in the country. All in all, Russia, Belarus, they accounted for 10% of our net sales during the first half of the year. We have strengthened, focused on sales, distribution channel to strengthen this activity on the sales front and to, let's say, sharpen our sales management practices. All in all, we are geared up for growth. We have now finalized the investments that we have planned for, focused on the top hammer side especially. We have taken a, let's say, big increase on our production capacity. During the quarter, our lead times have improved, and we are in good position to capture market share in this business. As a recap, our financial targets, Robit targets 15% annual growth as well as 13% comparable EBITDA. During quarter 2, we met both of these targets, growth over 20% and EBITDA also over 13%. Also, the first half results show that we are clearly, steadily and consistently developing towards these targets. outlook, as considering the risks in the market, we estimate that the demand in the mining and construction industry will remain at current level. We have identified the risk related to the war in Ukraine, cost inflation, as well as the, let's say, potential global decline of the economic development or the lower growth estimates. But we don't see that they are unlikely to substantially affect the company's operation in 2022. We also reiterate our guidance and estimate that our net sales will grow in 2022, and our comparable EBITDA in euros will improve, assuming there are no significant changes in the exchange rate compared with 2021. Now the floor is open for questions. You can just speak loudly.
Okay, very good. So it's Erik from Inderes. I've got a handful of questions, but maybe I'll start with just the first three. First, are the price versus volume components in your Q2 order intake and sales. Could you give us any kind of hunch how those two developed?
Yeah, as said, pricing management has been a key focus area for us in quarter one. After quarter one, we communicated that we were, let's say, late in implementing the pricing actions, and on top of that, then we hit the high peak in the raw material cost as a result of the war in Ukraine. So we have taken, let's say, obviously you see on the reported numbers that we have taken actions on the pricing front, and the pricing level compared to quarter two last year has improved due to the actions we have been taken. So we don't give out the exact numbers how these components play, but let's say there was a big contribution also from the increased price levels in quarter two compared to the 2021 quarter two.
And again, still continuing on the same subject, has the new pricing methodology already been fully implemented, or is there still something positive to look forward?
Yeah, I would say that we were able to complete the pricing actions that have been decided so far well in quarter two, and let's say most of the impact from those actions we saw already in quarter two.
Thanks.
Yeah, maybe Antti on SCB. Just on the order intake, I mean, it was flat year over year, and you would expect that there's positive effects and pricing impact in there, so the volumes are a bit lower, most likely due to Russia. But how should we think about your lead times? I mean, can you now, going into second half, achieve a faster kind of orders to sales conversion than last year, or is it just that the logistic bottlenecks and things like that are still kind of limiting that?
Yeah, I don't think our lead times are such limiting. I see it more as an opportunity. We have significantly improved our lead times from our factories as a result of the investments we have completed. And also, the nature of the business is that we have a pipeline of products all the time going to the markets close to the customer. So I think we are in a very, very good, let's say, position to have a fast rotation of book to bill, and that's not a limiting factor for our growth.
And then kind of you referred on the inventory side that kind of the inflation and effects is visible there. So are you kind of, is the same magnitude visible now on your deliveries going forward? Are you kind of happy with the balance that you have, kind of coming back to the price increase side?
Yeah, I think, if you think the price increases we've implemented, I think we have compensated the cost inflation on our prices, and we've succeeded in that front. Obviously, then on the cost side, we have actions ongoing on the procurement side to lower the cost base and create savings on that front. And there were good steps completed during Q2 on that front, but it is more, let's say, gradual improvement that we will see on the let's say, procurement savings side.
Then on the receivables and related to the Russian business in second and third quarter, you're selling, but are you getting cash out from that business to the group numbers?
Yeah. Let's say we've been able to get the money out from Russia.
Okay.
Okay, Sergei, again, how sustainable do you see is the Q2 profitability? I mean, given that you already reached the 13% EBITDA margin, where are the risks?
Yeah, in a way, we did very timely actions on the pricing front, and as said, kind of the results realized well during Q2. At the other hand, let's say the cost impact, for example, on the spike in the raw material cost that was caused by the war, that realizes again gradually because there is a delay. So I think it is fair to estimate that Q3 our cost base is still slightly going up. Before, how it looks based on today's let's say raw material steel price situation, maybe it starts to decline, but again that will come with the lag and with the delay as it flows through, let's say, our pipeline and the deliveries come from the suppliers.
And then on freight prices, the high freight prices have kind of dragged your profitability in recent quarters. You didn't say anything of freight prices in this report. Is the situation kind of normal, or how do you see it going forward?
Situation is not normal, but situation is better than it was in Q1. I think the freight market has, the pricing in the freight market, that has gone down somewhat from the levels we were at the turn of the year. Still the lead times are long and longer clearly than normally. But price level has gone down. We've done also our own homework and actions on that front, and we had good improvement on the freight cost in Q2 compared to the Q1 this year. But it's not yet a normal market, and I think for the second half of the year we continue to see inflated levels of freight costs also rest of the year.
And finally, did you take market share in the first half, as one of your competitors said that they will concentrate more on profitability?
Well, I think you can do the math on the numbers as well. Obviously, well, I think market share during one quarter, I think things don't necessarily change as quick, at least permanent changes on the markets. But obviously we are very happy with the growth we were achieving, and definitely I would say we were not losing market share. So
just one question from me still. Net financial and cost of debt, I mean, given the rise in interest rates, what should we kind of expect going forward for you guys?
Yeah, I think we can fairly expect that there's no major changes on that front. I don't know, Ville, if you want to comment on that.
Yeah, actually, the interest rate in our financial agreement will now drop the interest rate that we've agreed. Now that our net debt to 12-month rolling EBITDA is under 3.5, the interest rate will come down a little bit, but I don't see any significant changes on the interest levels.
And then finally coming back to the low-cost country utilization, could you describe the progress you have made so far? What has happened in the first half of this year?
I think if we think what I was referring to, let's say, good development on the procurement actions, it was maybe the improvements we've seen now or steps we have taken are maybe less related to CCC suppliers, more related that we have done, let's say, good RFQ rounds resulted into let's say, good potential savings going forward. But the implementation of the, let's say, new supplier base is ongoing and we'll see some results still during this year, but it's a gradual ramp up all in all, and yet, let's say, from those actions we see limited actions results realized on the first half of the year.
So we are still kind of taking first steps in this or on this path.
I think we are taking let's say, first steps on this path. Any other questions?
I guess perhaps I can continue. Still coming back to the Russia-Belarus sales, any kind of a ballpark how that impacted the two divisions down the hole and Top Hammer, and kind of just modeling those two in the second half, how should I think about that one?
Yeah, I think that if you look our East region sales, maybe it was more skewed towards the Top Hammer sales, but there were also larger deliveries on the down the hole. So I don't have an exact figure on the historical comparison how it compares.
And finally, on the mining market, okay, the estimates are that the metal prices are gradually coming down, but do you expect the mining market to remain fairly stable on a high level during the latter half of this year? Do you see that the prices are still way above those levels where they are way above the cash costs, so that the mining companies will still produce as much as they can?
Yeah, I think these levels still support, let's say, the consumable business to continue, and as we said, we expect the mining market demand to remain at the current level. All right. Any further questions? Then we thank you for the participation, and please join us again after the Q3 results.
Thank you.